Want my latest market insights? My latest report, Recession Risk Just Got Pulled Forward, is now available. Scan this QR code or click on the link in the description. Hey, greetings and welcome to Macro to Micro Options Power Hour. I am Samantha LaDuc, founder of LaDucTrading.com, joined by our options mentor extraordinaire, Hans Albrecht, and we actually have his two-part option course also on the LaDuc Trading website. You'll find that both the courses and the mentorship separate from our membership service. Those are just standalone products. So if you want to learn options at your own pace and or with direct mentorship, you've got those options. If you want to work with a team of 10, we have our club and very, very active subject matter experts providing all their analysis, education, and trades individually based on their timeframes and asset classes and all that jazz. And then we come together on a Wednesday, which is basically this kind of public-facing venue. And we talk a little bit about the macro event risk that might be on the horizon. That's where I like to focus. Any trends that are hot or maybe even cool, like the AI. And then, of course, we kind of move right into some options structure discussion about the market, not to mention sector rotation and individual stock plays, as well as the options that we manifest for that. And we take your questions. So you hit us up in Zoom Q&A or chat as you like, and we'll monitor both. And then basically, okay, let's just kind of get into this post-summer vibe, which is kind of sad. I refuse to put away the colorful shirts. And I know that you probably are still in the pool because your winters are long, and that's Toronto for you. But we've got non-farm payrolls coming up this Friday, and that may or may not be eventful. And I say in that particular way because we have a new BLS director in town, and he threatened he may not release the report. If he does, we don't know if we can trust the report. But in addition to that non-farm payroll, we do have the 9th, which is not just the Apple event, but the development conference, but also Goldman is estimating that they will do the job revisions then. And that would actually be more of a kind of a risk event that we need to plan for, which is to say they're estimating between 550 to 950,000 job growth revisions, which would be the largest in some time. And in fact, we just had one recently on August 1st. Market did a little shake and bake as a result of job growth revisions of 213,000, which followed, by the way, lots and lots of talk from Powell about the labor market being weak and inflation being stronger than they expected. And so therefore, they are trying to thread the needle, but they are looking at potential accommodation come September FOMC meeting, which is on the 17th. And that is all about a rate cut. And that is all there is about the labor market. If we're going to find out some data between the 5th and the 9th, and it's weak, then we can expect the Fed to cut. Will it be 25? Will it be 50? Remember, in 2024, they did a surprise 50 basis point rate cut, but this was immediately after job growth was revised lower, 818,000. That was a September 18th FOMC meeting with a surprise 50 basis point cut. On an August 1st, 2024, 1,818,000 job growth revision. So that's why I say we need to kind of be aware of what's happening with the Goldman revision count and recession risk pulled forward if we do, in fact, get labor market weakness. But other than that, we're looking at a little bit of a growth scare that may turn into something a little bit more now that Nvidia has reported. And we were doing this live, Hans, last Wednesday, and it was kind of interesting because I had my 172. It tagged perfectly during our live session on Wednesday, and then it rolled underneath on Tuesday. So it actually hit again by Friday during regular trading hours, and then Tuesday when we came back in after the long weekend, we had a gap below. And remember, that was my warning. It was hedge the Qs down to 559 for this week. We already hit it. And Nvidia down to 169. We already hit it. So those shorts are working, and it's pretty much just that whole expectation that I have that Microsoft post earnings, when we did that live, would also be as good as it gets, a reversion to the mean trade. And literally, Microsoft, Oracle, Nvidia, and the Qs were all reversion to the mean trades. It does not mean, so short duration, it does not mean trend reversals. We could still get some shake and bake the next month, which is my baseline bet, and then move higher into end of year. And that's all I want to say about that. Send it over to you. What are you looking at?
Yeah, I mean, I think you're right. I think this is a pause, and I think it's a game of hopscotch. I think it's in a matter of big cap tech or growth tech or medium tech basically pulling back while other things kind of recover. I think it's just a matter of, well, who's going to pull ahead at this point as part of my kind of roaring 20 scenario where it could be a tide that floats many, many boats in the long run as we see this very underappreciated, incredibly, to say that word, underappreciated regime change in terms of what we're heading into over the next few years of what the productivity positives from AI, et cetera. So I think things are more positive. I mean, we do have this issue with tariffs. I think they need to find some money, but the market again is shrugging it off. So it has this sort of ability to AI trumps everything in a sense. But having said that, I sort of watched this growth, Russell 1000 growth versus value. And we saw that big pullback maybe about a week and a half ago. We talked about it after, I think it was after the Nvidia earnings. So we had a little pullback. And so that chart that I watched, that relationship is below the 20-day moving average for the first time since about almost the lows of April. We had a little bump up and then it came back down. So April 21st or 22nd, right around there was the last time we were below the 20-day moving average on that relationship. We are now below it again. We rallied right almost back up to it. We didn't touch it, and we pulled back down to sort of the lower Bollinger Band there. And so I think there's some work to be done. There's damage on the chart, and that's sort of playing out as we can see in terms of the broadening out. Mag maybe kind of not getting super excited apart from Google and Apple, which is sort of an individual situation, a more idiosyncratic situation. I've loved Apple here. I've been telling everyone to buy Apple, and people have been very negative on it. But I've kept saying, I don't really see what the problem is. They're in all the right places. Who cares that they don't spend hundreds of billions of dollars on AI? That's actually probably a positive in their case. They are not in this race to create the greatest AI model in the world. They are in the race to basically do what they've done so far, which is have one of the best devices in your pocket. And it's sitting there waiting for all these great things to potentially happen as AI moves into the edge and into your pocket. So they're there. So we've had some nice reactivity out of that. I've been long Apple.
Just real quick on Apple and Google, because this was actually, I don't want to gloss over it. We really had a gap down Tuesday morning, and then we hit those, right? The 559 Qs and the 169 Nvidia. Apple's been going sideways for 5 weeks. It's been really a nice channel between 137 and 220. But the point is, this is an antitrust decision that was basically revealed after hours on Tuesday night, which is the cause for Google's explosion higher with Apple. Basically, Google's allowed to continue to be a monopoly, and Apple benefits the most because of the fees that it collects. Long story short, it really helped the Qs to bounce right back into that gap where they fell from Friday into Tuesday. So it was actually an intervention, if you will, for the stick save that we had, or the positive end of day result that we had, was because Apple and Google were bid so strongly on this antitrust division, which gives basically Google its power to retain itself as a monopoly, and definitely benefits Apple. So I know you're long Apple, you like that one. I see it more of a channel surfing play between, anyway, it's monthly support levels, which most people don't care about. But for digestion purposes, it is very much this 237 to about 220. And there is just a really nice consolidation here for about 5 weeks. All right. So you're long Apple. What else you got going on?
Well, those were names they hadn't really participated in a way, right? So they finally gave them a reason to participate. Google for other reasons, for the antitrust, but also the sort of threat to search, which has been kind of this ongoing thing that's kept it at a much, much sort of lower, below market multiple valuation versus everything else. And then Apple, not super, super cheap, but kind of a little bit of a forgotten mag. So I guess it was their turn to kind of have a little bit of positive news. And they've both, I mean, Google's had an incredible run. I was negative on it for quite a while and then hedged myself. So thank goodness I did that on Google. Missed an opportunity, but it didn't get too ugly. So that's okay. That's a win sometimes, is coming out not smelling too bad after a poor decision. But yeah, I mean, I don't see the issue there on the mag side. I just think any reasonable dip on Nvidia is absolute buy. People just don't get that that's not even about hardware anymore. At some point, it's about software and their ecosystem. So I think that's still going to be positive. I know we've got China competition, and these things always kind of come around again and get people nervous. But I'm looking at one of the other things that I love to look at is that breakout ratio, that sort of Cathie Wood versus big cap relationship. And it's been sitting around that breakout spot that I pointed out that it's hit 3 or 4 times over the last 2 years, so since early 2023. 2023. And it's just kind of coiling. It has really not pulled back very far. So from that perspective, it makes me feel like the animal spirits are still there. We saw those snow earnings were amazing. And I think that has become sort of my Palantir. They sort of go together in a sense, and as well as Databricks, as you know. But I think those are kind of the names that if you listen to what ChatGPT is saying, or OpenAI, they're saying there's so much compute going on. We're choking. We cannot handle it. The AI agents are throttling it back. People are using this stuff way more than anybody imagined. And I suppose at some point there will be constraints perhaps on the power side, on the physical ability side to keep up with the demand that's out there. Because really it's the first pitch of the first inning in terms of how this stuff is going to sort of play out throughout the economy. So I think there's a lot to look forward to on the AI side. It's nowhere near done, not even by a country mile. As we know, those stocks just don't always go straight up. So we're going to have a little bit of back and forth as we always do in manias. But I think the mania is still just, I think it's on pause right now, and it's only going to get it pushed even further by rate cuts, Trump having all the right pieces in place for him to continue to be a naughty, naughty boy fiscally. And we'll see if the market disregards all that forever. We definitely had a little bit of a scare on the bond side, didn't we, Samantha? That gave people a little bit of pause.
So I think on the bond side, we have yields that are rising globally. They are kind of staying in check here in the US. Sticky, very, very sticky, as our dollar continues to get devalued, debased, de-dollarized, all the above. But as it relates to equities, this is definitely still for the 10% or a little bit more, but basically very, very wealth building. And unfortunately, there is a very large mass of folks that are not participating in these inflationary effects. So that will come to hurt, plus layoffs and such. But the bond market right now, it's Greek statue. It's not moving. So I'm looking at that yield steepener that I've showed repeatedly as the risk off level that's coming, where we actually will get a bid in bonds, but we're like 30 basis points away on that steepener. So this is the 10 and 2-year yield curve, but you got a bunch of these curves that are steepening. So basically the longer end is staying bid while the short end is falling on rate cut expectations. Come hell or high water, Trump wants his rate cuts, and he's going to stack the FOMC bench with loyalists to make sure that we get this loose monetary policy on top of loose fiscal policy. All gas, no brakes for fiscal, all cuts, no inflation for monetary. That's a monetary illusion, by the way, especially as the dollar keeps falling. But what will interrupt or upset the apple cart is if this picks up speed to the upside. So this is a positive, by the way, 0.64 basis points for those who are in fixed income. This is when they did their cut of 50 basis points back here, just after it had uninverted. Anyway, long story short, we get some pickup in this indicator. It's going to be absolutely tested this Friday and next week on the 9th, not to mention the FOMC on the 17th, the rate decision. If this starts to pick up speed to the upside, it will be a headwind to equities. But bonds are definitely US not so safe yet. I think we need to get, and I said this in December, right? This is literally this bull steepener, which is not even a bull steepener because we're now moved from monetary dominance to fiscal dominance. So this is going to steepen, but not necessarily bonds get bid. We're actually going to have, I think, the flip where this steepens and bonds stay very weak and don't get bid until about 90 basis points positive. Anyway, we'll see what happens in the next literally 2 weeks as it relates to employment. But the rest of the world is definitely seeing the inflationary impact push yields higher. Dollar yen has been really, really kind of stoic as well, gyrating in a tight range for the past few months, while inflation increases, while the threat of a rate hike in 2026 increases. But we have also seen the Bank of Japan do this little interventions of debt, little funding to make sure that there's plenty of yen to short. So I have not seen, even though I have seen dozens and dozens of these small interventions, 20 billion yen here, 20 billion, 80 billion there. The point is, it has been very, very fruitful while they do these interventions to have more yen to short, basically. So that's also helping the US equity market. I follow my rate differential stuff and it's still pretty bid, does not look right here, right now. And I've been saying this for the past few months, right? All summer long. I said, I still don't see a yen carry trade unwind part 2. I'm specifically looking for when that happens, and right now we don't have it. So yes, yields are moving strongly higher in Japan. There will be something that breaks, but it is not front and center. And our bonds right now are not getting bid. I am still not a bond bull, as you know, and I'm also not Russell 2000 bull either. I'm the anti-Tom Lee. So I think they're kind of two sides of the same coin. So I'm not excited about getting in front of that train as it relates to betting on a bond spike. I think the steepener is a better tell. So you've got not really too much going on in the macro side. We've talked a little bit about gold. I showed a few weeks ago a very detailed intermarket analysis. You can go back literally 2 weeks ago, maybe it's 3, where I talked about my gold miner bullish percent index. So everyone's now going, oh my God, gold is breaking out. I'm like, I knew that. So gold was not just in a consolidated wedge pattern, and it has all the macro reasons to go long until we get balanced trade and or balanced fiscal budget. And what are the chances? So until that happens, there's no reason to short gold. But in the meantime, the intermarket analysis, I said, could be very bullish for weeks, if not months. So we have started a parabolic move in some of these cases for gold, silver miners, and especially the junior miners. So we've been on top of that from a macro trade event. So not interested in oil. There are better things to trade. Not interested in bonds. I'm definitely more inflationista and definitely bullish and have been bullish the precious metals. So I'm pretty happy with that still on the macro side. And then as far as sector rotation, just timing these growth value shifts, which can be very short duration, right? July 31st. Option stack was huge. And once that gamma comes off, I'm like, prepare for some shake and bake. Same thing with August 15th. Options expiration that went into August 20th, which was in fact the VIX expiration. So this is the market structure. Hopefully you can see this. This was this July 31st stack, and then this was August 15th. And once they come off the board, it becomes very volatile. And that's exactly what we got for those who are looking at SPX, just as an example. This was exactly this. Look at that gorgeous July 31st, dumped right into that non-farm payrolls print. And then what happened on the 15th? Right here is the exact August 15th. And what did it do? It dumped right into VIX expiration, 820. Can you see that? All right. And what was that? Oh, yeah, that was Nvidia, another top of short duration. This is why I had Nvidia, this 169, the Qs 559. These are just reversion to the mean trades. They're not trend reversal. So just to kind of clarify that.
I agree. And that 6,400 level was big. I think as the market has shown a number of times over the last few months, it has shown that it can handle those sort of pivot points, those sort of gamma flip areas where below 6,400, in theory, there was the potential for an acceleration to the downside, and the bulls absolutely defended that once again. Those kinds of examples just make it very, very difficult for bears to kind of hold their position and really have much of a claim that this market has this potential underlying weakness that just needs to be triggered by something like a gamma flip like that. It held yet again and keeps coming back. It isn't always the Mag 7, which is amazing. We see this market kind of very resilient, even as we move to other areas that are starting to act a little better. I mean, I think there's probably some argument for manufacturing numbers to improve at some point, PMIs, things like that. And I think you sort of see it in some of these numbers, some of these names that have been doing okay. I think semiconductors will obviously continue to do well, but capital good companies are doing very, very well as well. So I think, and then of course, now you've got sort of the banks taking over. It isn't just the capital market plays like the Goldman Sachs and JPMs. It's some of these other ones as well, starting to react more positively. And really, if you look at them versus the S&P, there's a lot of room to the upside there. So if you sort of look at that relative to the S&P, the banks have been coiling for the better part of since say November, December. And I think they're almost ready to go again. So there's all these little things that are picking up on this potential for rate cuts to come. I think everybody's figuring, okay, we're going to get 25. I'll agree with you, Samantha. At some point, you can't have your cake and eat it too, in a sense. You can't have all this amazing growth and the potential for some areas of the economy to get rejuvenated and for all this productivity to work its way into profit margins and an increase in activity and economic activity without inflation kind of at least sort of hanging in there. So something's got to give. There's always going to be that little variable that people think about, which is AI. So in the sense that maybe the internet in the 90s was the beginning of being able to kind of cap. I think there were other things like cheap Chinese goods and labor and things, there was a very special time for economies to be able to take advantage of many good things, but maybe this is a little bit like the internet. We know it's going to be difficult for certain jobs. The numbers for job openings are terrible, terrible, terrible. It's not so much that people are getting fired, it's that the openings are just not good. And so there's going to be wage pressure to the downside at some point. So there is this ability to have AI, perhaps not for the better, but maybe for the worse, kind of keep a cap on inflation to some extent. So is that the thing that resolves this issue of, can the economy continue to do well or to bounce back because of AI, yet still not have inflation get out of control? And I think that's kind of the thing that everyone's got to sort of figure out. At this point, Powell is saying, well, look, it's we're not as worried about inflation as we are about jobs, which I said 4 or 5 months ago. I said he's not going to care about inflation at some point. It's going to be all about jobs. And it is going to be that much more important thing, even visibly. I mean, people losing jobs or not getting jobs, that's a bigger issue than, I don't know, certain areas of the economy having inflationary pressures. So it's going to be kind of this interplay between all these things going on in this new world that we are going to have difficulty in calculating. We don't really know how it's going to play out. You look at the snow numbers, and this is just getting going. And that MIT study was the best. Like, it was completely clueless. Of course, people haven't figured this stuff out yet. It's very, very early. So once they start to figure it out, they're going to be clamoring to figure out what to do with all this data. So I think it's a very good place for these data warehouses and warehousing companies that figure out all this stuff. So it's going to be an exciting time, but I'm not really sure where the inflation. I feel like AI is extremely deflationary in some ways, but in other ways, you have to figure that we're going to certainly have a shortage of certain items at some point, rare earths and things like that.
So let's talk a little bit about, because you covered lots of different things, but as it relates to trading themes. So I've got a very strong theme I've been on since last year, that we would see recession risk pulled forward at the end of this year. This was before Trump was elected. This was before the Trump tariff terrors and the delay of such. It was also before, and I really, really want to emphasize this point, is the greedflation, which is not really talked about, but in fact, in the last iteration of looking at what contributed very much to the PPI, which is producer price index, which is rising, and this debate about tariffs are inflationary or not. What's actually been very inflationary are margins. Corporate margins have been bid from McDonald's pricing themselves way above the competition to maintain margin, which is, by the way, helping them maintain a pricing of their stock, but not necessarily for their audience to consume as much. So the CEO was on yesterday talking about how they're seeing a shift in traffic. It's down by, I forget how much he said, 1/3 or something. Well, at the same time, they're charging more than their competitors by a significant amount. They're really taking at the front running the tariff hit on higher prices. So they do not have margin contraction. So that's greedflation. That's just like front running.
$75, Samantha, for me to take the family to McDonald's on a road trip. $75, and I don't think my wife even really had anything. So they are definitely making this decision that can't be popular with the masses, which is, okay, we're going to grab some of that trade down, maybe from mid-tier restaurants. We're going to grab that trade down, and we're going to throw everyone else under the bus who used to enjoy our $4.99 meals. It's a real shift. You're right. That's a very...
So this will start to hit disposable income. This will hit consumer spending. But for right now, the market is rewarding a massive, beautiful beat. So Q1, we weren't worried about. Q2 came in roaring. Q3 and Q4, I contend, are going to be slowdown periods, not just because they've pulled forward so much of this demand, whether it be goods or services, but also in corporate margins. So I think we're going to see a massive earnings growth slowdown in Q3 and Q4. That's number one. We've already gone through the shrinkflation. We're not near deflation, but we definitely will see consumer spending hit in certain categories, which is going to hit corporate margins, et cetera. So I still have this baseline bet that we're going to see a very different view toward the end of the year as it relates to the regular economy. But I also want to say I've got this thesis also where we have to focus on what's coming up that is very bullish. I can go through growth value, rotation scare charts, steepener charts, job growth revision charts. They're all very scary as it relates to a pullback in the equity market. And then, of course, what happens with employment. But we've got corporate issuance coming back. And so that's why I'm a little bit more negative until FOMC. But the corporate issuance should be coming after FOMC. So we should get these numbers. And what does this mean? Because we're already record levels, I think 1.8 trillion year to date in corporate bond issuance and about 1 trillion in corporate stock buybacks. They're tied. So we have this situation where if we can get a very, very strong September 2025 corporate issuance like we did last year, we can absolutely see the markets run up into end of year. So we're not there yet, but that is why I am still of the opinion that we're going to have a lot of chop, which means careful. It's not going to be, we're not on breakout mode. In fact, I mentioned to clients before we hit that 65.05, that JP Morgan collar we talked about. I said, I think it's done for now, at least until FOMC. We're going to have chop until FOMC. And then let's see what the corporate bond issuance looks like. It's expected to be very, very good. That will carry the momentum forward into the end of the year. That's assuming we don't have a government shutdown. And I know I've teased on this in prior shows. And luckily, Dr. Kenton, our biopharma, believe it or not, it's Kenton's Corner of Biopharma. He posts all of his analysis on the healthcare arena, but he's also really interested in how the sausage is made in DC. So he tracks that exceptionally closely. And there are some rescissions, which is congressional speak for decisions on how the money is going to be spent that was just approved by Congress in the OBBA bill that could actually trigger some government shutdown risk. And so no one's paying attention to that. That would happen around October 1st. So of course, if that was to happen, that's, by the way, GDP contracting. We're talking employment rates going to spike because of all the contracts also that are tied into the government world, not to mention just government employees. They're still going to get paid. The contractors don't. So anyway, long story short, we could have a very robust September corporate bond issuance and have a government shutdown. And that's obviously going to cancel out the benefits of the September bond issuance. So kind of keep that. Those are the moving parts from a macro event risk standpoint. As it relates to the market structure for options, I do this live trading room with clients and I'm like, I still see it as a chop fest into FOMC. And then we're going to have to see if we can get this corporate issuance and the bullish bent into the end of September. But I don't see it yet. So yeah, I don't see any bullish bent except for like 2 days. And I can see where the 2 days are likely to be. It's after the event, after we've got through sell the rumor, buy the news, September 9th, job revisions date, or FOMC September 17th. But that's not a trend. So I think we really have to be on guard for the next few weeks.
It's a signpost, right? Sometimes the market, I've found over the years, is that sometimes the market is just going to float around in its sort of whatever mode it's in, and it sort of looks to some sort of landmark or signpost. And the FOMC is as good a one as any because everyone knows that rate cuts typically aren't that great for markets. They haven't been necessarily every time, and it sort of depends on where we are. So if we start to see more weakening data on the economy and then on the employment side, that combined with a rate cut may not be incredibly positive, but if we see some resilience out there and then we get that rate cut, if the market sort of feels like, okay, he's finally relenting, they're too restrictive, he's finally giving up, then that's going to be a positive, I think. Lower rates and all these other positive things that can be happening on the AI productivity side, that could be the thing that sort of sparks that year-end rally. Do they care about seasonality in September and early October? Those are typically worrisome periods.
I don't see the productivity being a driver anytime soon. I hearken back to that 2000 top. Nvidia didn't see that level in pricing for 14 years.
Cisco, Cisco, right?
No, but the Nvidia ecosystem could have the same type of event. So also productivity, everyone was excited about the internet, but productivity did not all of a sudden turn higher. It didn't for years. So looking for productivity numbers to confirm or deny AI is just, it's not how it works. So basically, I'm still looking for the reasons that I've kind of outlined, which is the market structure. We do have CTAs that look like they want to sell. We've been on this because of mechanical buying. We can hit the wall. We did hit negative gamma with dealers. So then that can become selling begets that's selling. So we do have some triggers for more weakness. We have the seasonally strong months of September and October for VIX. But that's the spot right now. The future month, 2 months out doesn't look so scary. It's hard to trade that because it's already been elevated, but the spot looks low. It's anyway, long story short, we could do a lot of chopping without a big macro event risk, which is why I'm looking ahead at job revisions growth, a growth scare of size, and or a government shutdown, a corporate issuance that disappoints, but I'm not expecting that. And then last but not least, a yield curve steepener. And this is actually one that is going to upset, because we're all bond traders, that would upset the year-end rally. So
yeah, I think we could be getting a little bit of a charm and Vanna effect from that sort of below 6,400 as those positions start to, as fall comes in, as these positions start to near the end of their life, you get those deltas dropping. The dealers don't need to be hedged as much against those positions. So it ends up being a little bit of a floor. So in a weird way, that gamma area can actually be supportive in a way. So that's sort of the funny thing when it comes to these sort of gamma ideas, is you kind of have to figure out it's multidimensional, right? It's not 3D chess, it's like 5D chess, and you're one-upping Trump there. So being a gamma trader involves passage of time, the movement. So it's an area where I always say it sort of moves through time and space. Sounds like Star Trek, but really it's time and space being movement. And so that's always fun to watch. But to the upside, we aren't really seeing the exuberance. I sort of talked about how, even though I haven't been super bullish on some parts of Google, I remember saying the upside is just so cheap again. And so my hedges have really exploded because of that upside that has now come to fruition. So I think that remains. When I start to see that upside, there was a chart I had at one point that showed the exuberance in the upside call skew that we saw in 2021 and other sort of bubbly periods. And we're not there at all. We're not even close to being there yet. So if AI has kind of pushed things up a long way, it could get a lot worse. We're not seeing overall, broadly speaking, we're not seeing the kind of excitement in skew. I had a student ask me that today and sort of say, well, does this happen when you see the skew blow out to the upside in a stock? What does that tell you? And what that means, guys, for everybody watching, is upside skew is the call, out of the money calls. Are they getting excited about something happening, or are they relatively neutral on it? So we see that often in perhaps gold a little bit. We see that in the coin space, where you start to see those upside call prices getting pushed up, but they're not exhausted yet. That's a sign that people are getting excitement, but that there's still room to the upside. When they really blow up, that's when you're at a point where it might be a sign of exhaustion. It doesn't necessarily pick the exact top, but it's where everyone's going, oh my gosh, I'm short, I got to cover. Everyone's just getting exuberant to the upside. So there's sort of various levels of that skew that play out. And we're really, and in 2021, and in a true melt up, you see that happen everywhere. It starts to spread to S&P 100 stocks. Everywhere you look, it can happen to mags. It can get truly crazy. And we have not seen really anything like that at this point. So from that perspective, I think there's room for that to play out. I'm not saying it's going to play out, but there's room. There isn't as much excitement as you think at this point to the upside.
So not right now. And I do have that mini growth scare that is still in play, by the way. So it has not triggered, but it came really close actually on Tuesday morning before the Google antitrust decision. But as it relates to the gold, silver, you're asking about, is silver stretched yet? Be careful when GDX hits 67. That's the prior high. But ultimately, I still have my intermarket is very strong for gold, silver, precious metals. GDXJ is in catch-up mode, which can be very explosive. The CPI is expected to continue to push a little bit higher, jobs lower. Dollar, by the way, you know, I'm a big dollar bear, big picture, big bond bear, big picture, and hence gold bug of late. Like, just never wanted to be in a club. Yeah, that would invite me as a member, but they got it going on, don't they? Right? So, okay.
No, you called it. Down at 300, you said this is absolutely still a gold market. And you were right.
It still is, though, today. I mean, like, I'm looking at my stuff going, why isn't it getting rejected? Like, the only reason to short gold is if we get a balanced budget of any kind. So ultimately, I understand that, but I'm talking about the swings, right, within a trend long, and we are wicked extended. But I think right now we have 67 for GDX as a strong resistance area on this little parabola, and I'm expecting, honestly, the potential for gold to go another probably 4 weeks before we can have a tradable top, according to my intermarket. Now that could change tomorrow. We could have something from a macro standpoint change that, like a very, very, very sharp dollar bounce. But right now the dollar is still digesting sideways and has not, repeat, not had any interest in getting going. But in short, 67 GDX was my upside target. That's from like June 3rd. Okay. So we're getting closer. That's all I can say about that. So if I have a target, I'm going to extrapolate and apply that to everything else. But I would expect some digestion when we hit GDX 67.
I'm looking at the skew in GLD, and it's not, yesterday it looks like it was quite steep. It's kind of relaxed a little bit today. I'm not sure where that came from or if the data is in fact good there, but it's your typical structure that typically that higher call skew, because people are looking for that continuation move to the upside. It always plays nicely into maybe callers. So if you get a little bit nervous about your position, you kind of pick a spot on the chart. It's hard to pick a spot on the chart when you're making new highs. So that's a tough thing to do. You want to probably wait for it to kind of settle down a little bit and then kind of tell you that it's found a place where it's found sellers. And that's how I usually treat breakout moves and parabola moves. I try not to get in the way because you're dying to get in the way. You're up money and you just can't wait to put that money in your pocket. But the right thing to do is kind of wait. You're not going to ever pick the high. And so if you wait for it to kind of find a bit of a top and maybe consolidate a little bit, now you've found a place where it seems to have found buyers and sellers that are a little bit more in agreement. So I think that's probably the play, is you just kind of let it happen at this point. But if you are nervous, callers are pricing kind of okay, where you sell out of the money calls and you can use that to maybe buy some downside to protect your position as well. If it's something that you truly don't want to get rid of. Some people come to me and say, I don't want to get rid of my stock. I've owned Microsoft since $40. Then you have to use options to kind of play the ranges and periods of time where you think that the market may have a little bit of difficulty.
Jim is asking a question. I'm not sure, Jim, if you missed it or not, but I went over this Steepener where, and let me know if you didn't, I'll show it again. Happy to. Where we basically had September 18th of last year, the Fed did the surprise 50 basis point cut and we rose 100 basis points in the 10-year. So yes, long story short, I do think the Fed cut can show either no response or an increase on the long end. We're already there. We already have this bear, I don't want to call it bear steepener, because we're in fiscal dominance. So therefore, it's not necessarily bonds are not in play, period. But the long end is absolutely firm. The short end is selling off on the rate cuts, creating the steepener. And this steepener is forming a scoop pattern on a weekly that is very, very bullish, technically speaking, once we get above 6.64. So that's what I'm working with, and that's what I have been working with. And so far, it's working. The 44-year cup and handle in silver, yeah, that's pretty big, but I don't know if it's 44-year. Just let me see real quick. XAG. Let's do this on silver.
Oh, Salesforce is out, Sam. Sorry, I know.
Oh, you got something going on with that, don't you?
Yeah. I have an upside call fly, a broken wing fly, sort of playing a little bit of a bit continuation to the upside, and it's not happening. It's pulled back about $10. It's not a disaster, but
give it a minute.
Yeah, give it a minute. I guess it had a little bit of a run. It sort of ran from the 232 range up to 256. But I really would like to hear from them to sort of see what are they thinking, because of course there's this whole threat of AI eating software for lunch, dinner, and then breakfast. So it's very interesting. I think it's a bit overdone. So that's where my kind of thesis came in to buy it. I did buy it lower, so it's kind of still a little bit above where I got in, but it's going to settle here. I think it's actually going to probably bounce, but I do want to hear what Benioff has to say. Let's see. Sorry, go ahead.
No, that was it. I was just showing the silver gold relationship that's being asked as it relates to what about CPI. So I'm showing you a monthly ratio of mine where I posted this and said, this is the most bullish chart. And this is on a monthly and it's a ratio, but this is my intermarket stuff. This is the most bullish chart I have. It's basically March 1st, you can see 2024, gold took off. And then, by the way, silver followed in April. But the point is, this is very extended from the mean. So every time it does this breakout in the past, it has methodically digested sideways before the next breakout, shallow pullback to the 10. You know how I'm crazy about the 10 EMA as a trend indicator. Yeah. And I love these patterns. Anyway, this is working, but this did not digest to the 10. It started getting very extended. Yeah. This is a parabola, but as it relates to silver, you did ask, how is it doing? And this is, again, when we were talking back in, this is on a weekly, but I could show you on a monthly. The idea is right here. First week of June, silver was on its way. So you can see the same type of beautiful behavior in silver. Does silver look done? Do you ever short all-time highs? No. In the same way I say, don't buy all-time lows. They can stay overbought. So this is still moving. Now, GDX is a little bit different. It's got some massive, big miners that have just moved higher, and this is all fabulous. And you've got then here, GDX. This is the kind of the tell. 67
sure
is
extended. Yeah. Look back to when was the last time? When was the last time it got that extended, Samantha? Did it finally? That was back in March? No, April.
What are you talking about? Extended. It has not been this extended.
From the 10-day, like basically distance from the 10-day. Ready for mean reversion.
Right here, which was post-tariff intervention. And then there was a little bit of a Bitcoin run. Anyway, it hit technically a trend line, then it scooped again. Long story short, you all know that this is a sector that you cannot short when it goes crazy. It's just like, it is one of those where the gold bugs have been waiting for many years. And once it starts to go, it starts to become a little bit unwieldy, because then the day chasers come in and, oh my goodness, they wreck it completely. But this is, look at this thing. This is still all-time highs. Way the heck back here. So this is the junior gold miner ETF, which is finally starting to get its Mick Jagger moves. Anyway, so it's extended, but I definitely don't have any reason to say short this right here. In the same way, it is very extended, and it can come back and do a shallow digestion. There's no macro reason to remove these from your portfolio just because they're extended. I'm not quite sure if I'm answering the question. So in other words, I don't care about CPI and jobs as it relates to gold. This is a solid trend. What I care about is a reason, a macro trigger that would cause this to sell off aggressively. And I don't see any macro event risk coming in short of deflation, which we do not have.
In moves like that, I don't mind putting on little 1x2 put spreads, like a ratio put spread, because we're overextended. We're a little far from that 10-day, a little overextended, and you can sort of play. You buy something put a little bit out of the money, sell a couple down lower, especially when that put skew gets a little bit richer. And that gives you the ability to really play that downside for very little cost. And one of two things can happen. You can either get that pullback right away, and hopefully it doesn't go too far past the sort of 10-day or too far below that, in which case you end up having to buy the underlying, which is fine because you end up with actually a very good price relative to where it is now. Or we just keep going to the upside, and what you can end up doing is buy back those short puts as part of the 1x2. So then you end up with extremely cheap puts in a parabolic move that probably eventually has to have some sort of digestion. So those are some of my favorite trades, and especially when that downside put skew gets a little bit steep, which I probably isn't the case on GDX, because as we talked about earlier, that upside tends to be more favored. But there's lots of fun things you can do. You put on one of those, it's a bit of a hedge that you almost hope you're wrong. And if you put it on for a credit, then you can guarantee that you'll at least put a little bit of money in your jeans if it keeps going to the upside. And I remember doing that so many times as a market maker, and you end up with these cheap puts that you've forgotten about. And then lo and behold, something crazy happens. You've almost just forgotten they're in your book, and they go and they end up making you a mint. That's almost kind of like a finance your put trade. They're really fun. Somebody mentioned in the chat earlier STX. That's funny you mentioned that, because I watch STX and WDC all the time. The Seagate, Western Digital. I love those. I just absolutely think the demand is going to be off the charts for them. They are. Is that why you mentioned it? I think it was William. Yeah, William mentioned it. Amazing stuff. And everybody thinks Western Digital is that kind of passports, little hard drive on your desk, but they do a ton of work now. They've pushed into data centers in a big way. And I think there's just going to be more and more need for storage, because just listen to GPT, listen to any of the AI model companies. People are using this stuff and they're already choking on it, and we're just getting going. So anything that has to do with data management, data storage, I think those are positive areas. Can they pull back? Absolutely. But I think they will ultimately be probably areas to sort of add exposure as they pull back, as some of the power names have done lately. So the VRTs and the VSTs, VRT went from 150 something down to 120. So I think you look for those themes that are still very strong, the stories that are very strong, yet you've finally had that pullback. I think people just kind of reload on those things. But that's
We
funny.
need to talk about, speaking of sectors that are doing really the heavy lifting of being oversold and pulling very strongly higher. My fave, anyway, which is the China ADRs are coming up back again. BABA has recently pushed higher. I know we've been talking about this for literally 2 years, but the point is this has a good look, even though Chinese ADRs are very nerve-wracking. It's kind of like my thesis was the Nvidia short, the BABA long. It worked really well. I think JD is forming a very, very tight little, I haven't showed you here, but basically we're potentially pushing higher in the Chinese ADRs because the Shanghai is getting parabolic. So if we're talking about that, let me just show you.
They had good manufacturing numbers, didn't they, Samantha? China's surprising a little bit here. And
This one. This is one I've been on early and often with Jeffrey as well, who is our macro, believe it or not, classical economist who's very focused on bonds and currencies, but also fundamentals for oversold value plays. And he is up 440% in the last 18 months in his portfolio, playing primarily China names. So I'm very specific because I want to have robust options with this Chinese ADR to limit risk, because you never know if there is going to be an executive order that comes out by Trump and Besant that says, divest, we don't want American companies, we're going to delist, whatever. I don't think that would be good. It'd be bad for all ETFs. But the point is, you can still limit risk with some options. Long story short, this is the Shanghai Stock Exchange. I could put it on a weekly, I can show you on a monthly, and it is extremely bid from lots of stimulus. China's doing a lot better than Western media will let you believe. And some of the plays within this space are also competing very strongly for Nvidia market share in China. So they're doing extremely well. So long story short, don't ignore foreign markets. Maybe be a little bit more cautious on Germany. I think Germany right now is under some distribution. So we had some cheeky little shorts in Deutsche Bank, SAP, EWG finally has come back down. The DAX is basically softening. But for the most part, I think China rotation is fully in view. Really, just keep that in mind.
what about software, Samantha? I've been watching the IGV lately, and as we've pulled back, I wonder technically, what do you think technically? Is that something that could probably overcome this sort of worry that software is getting eaten by AI, given the pullback here?
It doesn't look like anything more than a reversion to the mean trade. It's digesting. It hasn't trend reversed. The whole market to me looks a little soggy. I don't want to, like I said, there's no interest in directionally playing long any themes that are looking like this, that have been in digestion for basically 2 months. When I look on a weekly, I see almost 3 months of sideways. I want to see breakout. I want to see a trend that stays very firm versus one in distribution, or one that comes down, pulls back into support and looks ready to launch again. This one doesn't look like it for me. So there are individual names, I'm sure. You mentioned Snow, I've mentioned SE, but as a group, I'm not so impressed. I think it actually could fall a little bit more and digest and then flatten and take a few weeks. And basically, I wouldn't touch it until after FOMC. So
Yeah.
I think we're going to have chop the next few weeks. There's nothing that I can see from intermarket, from market structure, from event risk. I don't see a breakout back into 6,500 and above until after we get through this choppy period. Potentially, I don't even know. We've got to see again. I want to see what happens over the next 2 weeks. But nothing's interrupted the trend, but it's definitely digesting right now. And I think we need to kind of respect that.
Yep, it's probably a little bit of a premium sellers sort of environment at this point for the time being. Sometimes we see that very nicely in the term structure, which shows you all the different option prices along the different weeks and days ahead. And it really isn't showing too much worry in particular anywhere until, let me take a look at the term structure here.
On which one are you looking at?
On spot gamma, if you sort of look at the term, it rises a little bit of worry rising into around September 12th. You've got Michigan consumer sentiment, core inflation, producer price index, of course, coming up on the 10th. So we do have a few things coming up early.
Yeah, I don't think we have a bullish bent until after we get through September options expiration, which is the 19th. Selectively, maybe individually, but as a group, I think we're just going to do a slog fest, which is not conducive to really picking a new sector or a new market direction. But in answer to a question on IWM, what's required for you to be bullish? Small caps outperform relative to growth or tech when tech pulls back. So it's part of that growth value rotation. And it doesn't mean that it's going to be hot fire flames higher. It just means it's going to outperform growth. And that's nothing for me, given that's not enough to get me excited about small caps, given earnings, which I think are going to get hit in Q3 and Q4, as I've already detailed. Also, the fact we still have 43% of those constituents are unprofitable. We still have an uncertainty around rate cuts being bullish for companies as it relates to funding costs. I don't think so. I think the long end is staying very, very sticky. Thank you very much. And it is not like 1998 or any other time when they started cutting. I really think that this is actually a completely transitioned monetary backdrop where we have very much so folks that big, small, medium, it doesn't matter, here and abroad, that want nothing to do with buying the long end from Dalio to Gundlach to I don't care what, Druckenmiller, countries, et cetera, because we do not have control over our fiscal house. They might be a little worried about rule of law issues too, but the point is there is no end to the worry about inflationary pressures as well. So term premia staying steady, long end staying steady, the steepener staying steady. Why get in front of that? There's just no incentive right now, I think, to kind of expect that we're going to have rate cuts affect a bullish backdrop for the Russell 2000. I just don't see it. Now, that doesn't mean we're not going to have sectors that are asset tied, that are commodity based, that are definitely benefiting from dollar de-dollarization, debasement, devaluation, no question about it. But I don't see the contingency of IWM itself being a safe trade. I just don't. I think it can outperform growth when growth pulls back. And I study all that rotation stuff, but I don't see any reason for it to be bullish.
Well, especially if you're not sure. The
What?
question, maybe we get a cut, maybe we get two, but maybe then there's a pause, because if we do get some firming of inflation or some stubborn inflation, then you're leaving yourself open with IWM. You're leaving yourself open to a potential oops-a-daisy where we don't get the cuts that we're sort of hoping for over time, which I mean, I think we do out to next year. I think we are going to eventually get them, but maybe not. So it's a play that can really sort of, it can take the elevator down, staircase up, elevator down rather quickly. Right now, it's kind of following a nice uptrend. I think if it holds kind of 228, 227, I think it's still okay. It's still kind of in a little bit of a bullish trend where it has been really since those April lows for the most part. So
let me just show that chart real quick, because there's no question. I agree with Hans on this. Technically speaking, I was kind of more broadly speaking. This small cap IWM on a weekly was a fabulous place to buy at the 400 week, this purple. I've mentioned many, many times that when a stock or a sector comes down into its 400 week and you don't expect it to go bye-bye, it's a really good place to sell puts. It's a really good place to look for a bounce. And it's a very proven, even in the Russell. But my point is the monthly here, where we did come off the 400 week, got back above the 200 week, rose finally above all the moving averages that mattered. And then slowly but surely, it's been a slog fest higher. Again, expected rate cuts, but that also comes with removal of Fed independence. So you get the double-edged sword. Be careful, because removing Fed independence is actually going to keep term premium very sticky as well on the rates that bondholders demand in exchange for holding these longer duration notes and bonds. So you sacrifice one for the other. Anyway, long story short, that red line is monthly. That red line is monthly. It is still moving slowly up, no question. But I'm talking about what you are saying with like a really strong trend advancement where the Russell is going to take off and the Qs are going to fall, relatively speaking. That happens when we have recession risk pulled forward. And so that's actually not something you also want to get excited about, because the economy suffers and there's more economic representation in the Russell 2000 than the cap-weighted SPX.
And it was very heavily shorted. The Russell was really, they piled on shorts. The downside skew was out of control. People were really, really betting against it. So it spent a lot of time basically unraveling some of that as well. So you have to remember there's also flows are a very, very big part of our market these days, which is why Samantha and I always talk about the CTAs and the vol targeting and these funds that either have to get in or have to get out. And so that's been a large part of this sort of last 800 or 900 point rally. I think there's more to it than that, but it is part of it. it. And with that exhausted, you're kind of seeing the result of that, which is we're sort of inching up to all-time highs a little bit here, but we're not blasting off. So anybody looking for that blast off right now just might not get it until we resolve things after FOMC. At the moment, you don't have that sort of assistance from some of these funds. You may, if we start to get going again, then some funds have to kind of get in. Some of these systematics may have to get in a little bit, but right now you're not getting the assist. You want the assist, you want things to kind of align in your favor, and you're only getting a piece of it. So that's why we're sort of getting little runs and then they fill in. You see that a lot these days. You get like something's up $6 or $7 and then it's down and then it's up $2. It's just very, very choppy. So you can expect probably more of that for just a little while longer.
And Ari will kind of have to answer those questions a little bit offline. But for now, you got my baseline bet that we have a lot of chop for the next 2 weeks until we get through options expiration on the 19th. So far, we played those dips really, really well as it related to the SPX Gamma stacks coming off the board July 31st, August 15th through August 20th. I don't think we're going to have that happen for options expiration for September. I actually can see a little bit more bullish bent potentially building up after we get through the next few weeks. We had to do Nvidia, non-farm payrolls, job revisions, FOMC. In between, we've got some other economic data for sure. We also have Lisa Cook. Is she going to actually weigh in for the FOMC committee? That's slogfest. We've got Stephen Mirren, who's been appointed to replace Fed Governor Kugler, whose nomination happens this week. We got lots of little tremors also geopolitically. So it's never a dull moment. We're just kind of outside of the summer laziness. Folks are going to start to get busy again. Bitcoin right now is not. Gold is. Gold has outperformed SPY this year and last year. I saw your question about, Rish, about Ethereum. It's holding that wedge breakout. Right now, I'm getting a lot of questions by clients about Solana. I'm not a crypto enthusiast, but I can technically assess and I can follow those who study on-chain data and all that jazz. So there's definitely still liquidity in the system if those types of speculative assets have a bid, and they do. So I'm not super bullish, but I definitely don't have any reason to be bearish. So, all right, the hour flew by. Ari, yes, you're K-shaped. I did a whole Sirius XM interview I do every Tuesday, but that one was actually focused on exactly the K-shaped economy and where this will start to manifest in the data around consumer spending, disposable income, and labor market weakness. And then, of course, the names to avoid in that situation, which will be very, very focused on consumer finance. So we'll talk about this theme if you want next Wednesday. But anyway, I hope we answered most of the questions. Thank you so much for being here. Wish you a great rest of the weekend, and see you next Wednesday at 4. Cheers.
See you, folks. See you, Sam.
Bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.